2019 proved to be a fantastic year in the financial markets, with almost all major investment types posting very strong gains. The fourth quarter didn't disappoint either, with most asset classes rising at a similar pace to the rest of the year. The contrast to the environment 1 year ago, following the worst quarter for many stock markets since the global financial crisis, couldn't be starker, although worth noting that most markets, with the notable exception of the US, are still below their 2018 highs. Putting some numbers around this, global equities gained 9% in the fourth quarter, taking their 12-month return to 28%. US and European markets led the way over the year, with gains of 31% and 27% in local currency terms, while the UK, Japan and emerging market equities rose less by between 16 and 18%. Unusually, bond markets also produced very strong returns, muted in the fourth quarter, but with most posting low teens returns for the full year. Even gold, typically shunned in risk-on environments, was up 18% in 2019. Various factors go towards explaining these gains. Many of the risks overhanging markets as we entered 2019 failed to materialise, and we started the year with depressed valuations across global stock markets. But most important of all was the policy pivot by the US Federal Reserve, which moved from an overly restrictive stance in 2018 to a much looser policy throughout the course of 2019, cutting interest rates by 3 times along the way. All of the Harmony portfolios gained in the fourth quarter by as much as 7% and 6% in the case of the US dollar growth and Asian growth funds, which led the way. That 3-month performance was nearly all attributable to the equity portions of the portfolios, with contributions well spread across our various underlying holdings. Several strategies which we hold widely across all of the portfolios ranked as the best performers. Contrarius and Jennison within global equities, Sands emerging markets, our gold producers ETF, all posted gains of around 12% in US dollar terms. Within the fixed income portion, our convertible bond holdings also outperformed significantly, with mid-single digit gains. In the US dollar portfolios, our US equity manager continued to perform particularly well. Vulcan gained over 16%, Granahan gained 13%, while Lyrical returned 11%. The sterling and Australian dollar portfolios lagged, up by just 1 to 2% in base currency terms, but that was due to significant appreciation in the pound and Australian dollar, which were up 8% and 4% respectively, such that in common currency terms these funds actually outperformed. The Cautious Income Fund returned 2.7%, bringing its first year total return, including dividends, to 9.4% for the US dollar hedged class. We designed the strategy to be focused on steady income-paying assets across a range of asset classes, so as to create a well-diversified and defensive blend. These areas, such as global listed real estate, high-quality cash-generative stocks, and infrastructure debt, turned out to be among the very best performers last year. More pleasingly though, the fund protected capital exceptionally well, only falling by around a quarter compared to the broader equity markets when they corrected during May and August. The other higher risk profiles within the Harmony range naturally benefited from larger equity weightings, which led to greater 1-year returns. The sterling funds once again lagged in local currency terms, but still achieved good gains of 8.2% for balanced and 10.8% for growth. The other portfolios delivered returns in the low to mid-teens, with the US dollar growth portfolio rising the most by 19%. Performance attribution for the year highlights many a stellar performance from our underlying holdings, including the likes of Granahan, up 51% for the year, Evenlow's UK portfolio up 24%, listed infrastructure up 21%, and even gold up 18%. Our fixed income and liquid alternatives allocations weighed returns down from a relative standpoint, but were still impressive, albeit on a very different scale. Their defensive characteristics were not called upon much over the year, but they still continue to provide valuable diversification and steady yields. The most notable disappointment was our global equity manager Contrarius, whose strategy gained just 4% over the year, significantly behind the World Equity Index return. Their contrarian investment approach was not rewarded last year, driven in particular by large allocations to certain energy and consumer-related stocks which underperformed. December showed how quickly fortunes can change though, with a 12% return over just 1 month. Value as an investment style has, on most measures, been out of favour for almost the entire last decade, while more growth or defensive-oriented stocks have led the market gains. History tells us this will not continue indefinitely, and so we retain a well-balanced exposure to different styles, sectors and managers across all of our portfolios. I wouldn't bet against Contrarius or other value managers being amongst our best performing managers in 2020. Although we chose not to adjust overall asset allocation during the fourth quarter, we did make various adjustments to the underlying manager selection across the portfolios. Firstly, we added an allocation to a fund run by First State's Asian-based team to provide our discrete exposure to Japanese equities. The strategy was launched in 2015 and is managed by the very impressive Sophia Lee, with support from dedicated analysts as well as the broader Asian research team. Sophia applies the same long-standing investment approach that the team have employed across the Asian equity markets for many years, focusing on investing in high-quality companies with a strong and sustainable growth profile. The portfolio consists of dominant mid-sized companies across a range of specific industries that enjoy strong pricing power and a long growth runway. The Japanese equity market is very large and relatively inefficient, so we believe an actively managed strategy such as this can achieve superior returns over the long run, whilst also helping to improve portfolio diversification given the highly distinct return drivers underlying the strategy. In December, we added a new holding to the sterling portfolios as well in the Merian UK Smaller Companies Fund. This is managed by the same team as the Chrysalis Investment Trust that we bought earlier in the year. While Chrysalis owns a concentrated portfolio of private companies, this strategy invests in listed small and mid-cap stocks and is more broadly diversified, thus is more suitable as a core holding within the sterling portfolios. This was funded through selling our FTSE 100 ETF position, so the net result was an increase in our exposure to UK small and mid-caps, but more specifically domestic-facing businesses. That area looked broadly undervalued on our analysis due to the market's overdone fears around Brexit, for which the related risks reduced substantially in our opinion following the December election result. Merian's specialist small and mid-cap team have extensive experience and an outstanding performance track record from investing in similar companies for well over a decade. Two other changes over the period, which are detailed in our regular fact sheets as well, include switching our high-yield bond holdings from AXA to a new fund with a broader global mandate, managed by Artemis, and also adjusting our liquid alternatives manager selection, ultimately increasing the weighting towards the Neuberger Berman strategy, which we have held for a few years and have built greater confidence in. We believe the conditions are in place for markets to make further upward progress in 2020, albeit at a slower pace than last year, and probably with greater volatility along the way. The global economy slowed last year, but didn't stall, as there has so far been limited spillover from the sharp recession in trade and manufacturing into the key consumer and services sectors. Recent data is showing some stabilisation in the manufacturing sector, and more broadly, employment remains strong globally. With inflation subdued, central banks have considerable flexibility in keeping policy ultra loose for much longer, thereby extending this extraordinary cycle, slower for longer and rates lower for longer. Furthermore, with growing recognition that monetary policy has limited room to provide further additional stimulus, there's rising pressure and political appetite for fiscal expansion in the coming year, which now looks increasingly likely in several major economies and a certainty in the UK under its new government. But caution is warranted in the short term. Markets have risen sharply over a year when corporate earnings were largely flat, leaving valuations higher and in some areas stretched. A period of consolidation is overdue and likely, but we firmly believe that the cycle has further to run. Higher asset values across the board are supported by yields on cash and bonds that are lower than in any previous cycle, something which we expect to persist for a considerable time ahead. Put together, this builds a strong case for staying invested while also ensuring genuine diversification in portfolios to provide protection from the risks and inevitable periods of shorter-term setbacks.